Crashes and booms are part of the market cycle. So, and the life of a bull market or a bear market is not something which is well defined. But only thing which has been being observed from the existence of the stock market is that investors are exuberant when markets are closer to all-time highs and valuations are not in favor. At that point of time, they usually invest and they feel betrayed by the markets because whenever the correction is due, they lose the most money. And on the other hand, right after a major drawdown, people are afraid to invest. So, and again, they miss out on the opportunity to make the money. So now let's look at the data and see if there are any lead indicators which can help an investor take a right call. Apart from the asset allocation and apart from the time horizons, are there any indicators which will help you? I wouldn't say timing the bear market or a bull market, but at least being cautious. So for this analysis, we have taken data for Sensex, gold, S&P 500, emerging market index, dollar, and crude oil as the asset classes, and we see if there is any correlation. So for Sensex and gold, we have taken in the rupee terms, and the rest are in the dollar terms. So the rupee depreciation is approximately around 3.5 to 4%. Accordingly, when we deduct from the returns of Sensex and gold, we get the dollar terms. So I have made this analysis using the data from 2004 to present day. The first data point is from January 2004 to December 2013. So Sensex and the emerging market index, right? So they have outperformed S&P 500 during this period. And if we look at the chart, the crude has appreciated a lot, right? And after the global financial crisis, gold has appreciated the most. So in the first half of the decade, it has not done so much, but it has delivered an absolute return of 190% in rupee terms. And in terms of dollar, it would be around 115% dollar returns. So from 2014 to 2023, Sensex and Sensex and both S&P 500 have delivered stellar returns. Sensex has given an absolute return of around 260% in rupee terms and around 160% in dollar terms. On the other hand, S&P 500 has delivered 150% in dollar terms. Gold in dollar terms has yielded around a return of 25%, absolute return of 25% in that entire decade, right? Which has been like really very low. So now let's look at the time horizon from 2004 to now. So from 2014, Indian markets have outperformed the rest of the asset classes, right? So S&P 500 on an absolute term basis has delivered around 400% in dollar terms. So dollar terms, and Sensex has delivered around 1150% in rupee terms and over 500% in dollar terms. That is, Sensex has done better than S&P 500 by 100% in the last 21 years. That's an absolute figure. So in the similar duration, gold has delivered around 240% return in the dollar terms. The overperformance of Sensex can be mostly attributed to its performance in the last decade, because till 2014, everything was at something at a similar range. But again, since this happens to be in the rupee terms, if you adjust it to dollar terms, it will be a lot lower compared to S&P 500, right? So there are several factors which have led to this outperformance, reforms, and demography of the country. And the rest of the world was not doing well compared to India in the last decade. So again, crude, which is happens to be one of the major importers, not just for India, for most of the emerging markets. I mean, like on an absolute terms, it has only generated, I mean, it has increased only by 100%. So that's something which happens to be, see, for example, for India, I think the logistic cost is around 20%. The decline of the crude will actually improve the profits of the country. I wouldn't say by country, I mean like all the input costs will go down. So for the companies, wherever the input is crude, their profits would increase. So whenever there is a drawdown, people usually talk about gold as safe haven, which underperform both Sensex and S&P 500. by 260 points and 160 percentage points respectively in dollar terms. Only cue we have from here is whenever the gold is generating higher return, that is between 2011 to 2014, right? And or after 2024, the market indices are being in the correction phase. So see, after hitting the peak, gold is usually stagnating for a while. Say, for example, between 2015 and 2019, the gold has hardly moved. So whenever, see, what is happening with the gold is investors will come into the gold and invest into it when it is peaking. So after a peak, what is happening is gold is plateauing for a longer duration. So not just here, even here after 2020. So during the crisis, it grew a lot. So from 2020 to 2023, it has plateaued pretty much 2024 beginning. It was almost at the same level. So this was at the index level, it would have been around 461. And right at this point, it is around 508 something. Like on an absolute basis, it is just an increase of 10% over 4 years. That too, this is in the rupee terms. So in the dollar terms, this would have been something like a negative return, right? So that has always been the case with the gold. So wherever you are looking, the accumulation phase for the gold is a lot longer. On the other hand, for Sensex, the growths are reasonable over a long duration. See, for example, from 2015 to 2020, just before the COVID, the Sensex has been growing steadily, right? Somebody may have invested here, whatever it is, they're receiving some steady growth there. And whenever the corrections are there, the drawdowns are there, it is not lasting for a very long time. So even here, if you are looking at it, the peaks are there, but it is still growing. So it is always a jigsaw way, but the trend is upward, luckily for the Sensex, right? And the corrections are usually short-lived. So in a way, this is actually giving investors a longer time horizon to make returns, right? So if you look at it from 2020 to 2023 or even 2024 till this point, anybody who has invested in this 4 years would be having a positive return actually. So in the case of gold, the same 4 years, they would be having basically flat returns, right? And when we look at the median returns as well, so if you look at it overall, the 1 year, 10 years, 5 years, all the horizons, there are only four instances where gold has outdone the Sensex. So that was mostly in the first year and the second year, and only in the seventh year it has done slightly better than the Sensex, but that was only 14 basis points, not more. So rest of the places it has always been the index everywhere actually. And this is something which shows that equity markets actually give a longer, given the longer horizons, it gives you a chance to accumulate. And even this accumulation, so you can do it with the growth, right? So whichever investor is there, he doesn't, because usually whenever it is tanking or whenever it is staying flat for a longer time, it usually, investor may usually want to go out of the market. Since it is growing steadily over a longer duration of the time, many investors stay put. But on the other hand, gold is not like that. So the one which is supposed to be a safe haven, so after its growth, it is plateauing for some time. And after by looking at this growth, people are usually getting into the bandwagon of buying this gold. And since there is an emotional attachment to it as well in a country like India, so people don't sell it and it plateaus for a while and again it increases over like another 1 year or something like that. And for the next 3, 4 years, it is plateauing. So always the chances of making money are more in the equity markets when compared to the gold. Only thing which you have to take into consideration is that you have to look at your asset allocation. So you have to see whether your financial goals and the time horizons allow you to take part in the equity investments, right? If it is something less than 5 years, you should not be even looking to invest in the equity. And as per the gold, so the median returns, when you look at it, essentially the debt funds have done well compared to the gold. And even on the volatility side, the negative returns and whatever it has delivered, it's not so great. So it makes more sense, to look at the hybrids debt than the gold. But again, if it is, and anyways, any household has a some part of the gold as inheritance, or you would have accumulated already. When you are looking at the total asset allocation, maybe you want to consider that as well before investing, right? So this video is for educational purpose only. It is neither a recommendation to buy nor sell the asset class in discussion. Thank you.